Buying stocks is absolutely exciting, but paying the wrong price can destroy your returns. That's why I don't chase hype. I only buy when the price is below the value. And right now, I've got 3 stocks that could be great buys if they hit my target. So let me show you what they are, how I value them, and the exact prices I would feel comfortable paying. When people ask, Paul, what stocks are you buying right now? My answer is always the same. Depends on price versus value. A great company at the wrong price can be a terrible investment. And that's why I focus on value and price, not hype. So in this video, I'm going to walk you through these 3 stocks that I want to buy before the end of September. In fact, I want to add to them because I own all 3 stocks right now. But I'm only going to add to them if the price continues to make sense relative to the value. I'm going to show you the story behind each company, the valuation metrics I use, and the exact price point that makes them a buy for me. Stock number 1. Again, guys, I own all these stocks. The first one is Starbucks. Never buy any stock because anybody on the internet talks about it. Now, you might sit there and see my analysis and it makes sense to you, but you still need to do your own research and understanding. Now, guys, Starbucks is an incredible brand. There's no doubt about that. Yes, they're expensive and people continue to pay for it. This is a company with a $100 billion market cap and with 37,000 or 40,000 locations around the world. The difference between their market cap and enterprise value is $37 billion, and that includes all those leases. So I think relative to the fact that it's retail, it's actually a pretty reasonable amount of debt. Huge returns on capital. Look at this, 45 to 50%. So what does that mean? It means that when they invest money in their business, when they open new stores, when they deploy capital to grow the business, they get a huge return on that money. Guys, that is the sign of a moat. When this number is this high, and guys, you should see, this number is higher than Microsoft, higher than Google. Only Apple rivals this that I can remember. That's incredible. Now, for the company, they're growing their locations and they're growing their revenue. 5% a year over the last 3 years, almost 9% in the last 5 years, and 7% over the last 10 years. And with very few acquisitions. So they're growing this internally by opening more locations and by increasing their prices. That's a huge benefit. $100 billion. Now, here's one issue I have here, though. Price to free cash flow is 44.5 last year. But look at this. In the last year, their free cash flow is $2.25 billion. In the last 5 years, the average is about $3.5 billion. So it's down in the last year. So the question is this a permanent decline that's going to happen with Starbucks? Let me ask you this question. Do you think Starbucks will be around for the foreseeable future? In the 1996 chairman's letter by Warren Buffett for Berkshire Hathaway, he said, and I quote, "Your goal as an investor should be simply to purchase at a rational price a partial interest in an easily understood business whose earnings are virtually guaranteed to increase over the next 5, 10, 20 years. That's what I see with Starbucks. That's what I see with basically every company that I own. Now, in the short run, it can feel a lot different. Starbucks has its issues currently. It is going through its issues. To me, it's also an indication of the economy in general. People are starting to pull back on some of the luxuries. And let's be honest, Starbucks is a luxury. It is not a requirement to live to pay $5 for a shot of espresso or whatever it is they sell there. It's expensive, but it doesn't mean it'll be expensive forever. When the economy turns around and becomes strong again, stronger, then that'll be a boost for Starbucks. But this is the important thing to remember. I do believe that Starbucks will have materially higher profit and free cash flow 5, 10, 20 years down the road. And that's very, very important to me. It's how I keep things simple. So for those of you out there who might feel overwhelmed, a big part of investing is about keeping it as simple as possible. A lot of people want to overcomplicate it. I do not. I look at this and just say, this is a pure example of how do I buy a good business at a rational price. So back to these. We've got a lot of great metrics. Guys, they spent a lot of money on dividends. My question is this dividend safe? Why? They paid $2.7 billion in dividends last year with $2.25 billion in free cash flow. That's something to consider here to go, wait a second, is the dividend safe? So even though this dividend is attractive, it might not be around for a long time. We have no idea. Or it might get cut if things get worse for Starbucks. Guys, all these metrics here are really important to understand. They feel overwhelming because they're all stacked like this. Don't worry about it. There's an easy way. Guys, I have an absolutely free PDF. Click the link below. Within a minute, you will get a PDF absolutely free that goes through all of these key metrics, explains them, what they mean, why they're important, etc. I do this because it's really important for me. Years ago, I taught for free at my high school because I wanted to teach people the real things that matter in life when it comes to money. Money's everywhere for us and we have to understand it. Especially if you're watching this video, it's because you want to buy individual stocks. There's a way of understanding companies. When you buy a stock, you're buying a piece of a business. And guys, in a few minutes, I'm going to go through the exact price I'm going to pay for Starbucks stock. But before we go there, let's look at our 8 pillars here. And by the way, interestingly enough, our average community member says it's a sell. So people are not feeling it in the community. At $88 a share, we'll find out if that's reasonable or not. 8 pillars, guys. First off, this is our debt level. Like I told you, their debt is driven by what? Their debt is driven by their leases. So I'm not as worried about this one. They need those leases in order to operate. So this doesn't concern me as an X. The 5-year PE, 5-year price to free cash flow, those are high. But again, their current cash flow is declining as they turn things around. This might be slightly exaggerated. And also, Starbucks is a premium business. It deserves a premium. The question is this a reasonable premium for the company? That's all we're here to ask. There are great companies out there, but if you don't have a point where you say this is not a good price, then all you're doing is no price is too high and you're speculating. So we've got to understand that there is a difference there. So what do analysts say about this company? Well, guys, $225 per share in profit this year, going to $537, 2.5 times over the next 3 or 4 years. So it seems like analysts are pretty optimistic. But they're analysts. They have their biases. What about revenue? Look at this. 6%, 8%, 9.5%, 10.5% revenue growth. Maybe. All I know is that inflation is going to help a company like this really increase its revenue. So these are important reminders here. Now, we have a story. We have some numbers. We put them together in our stock analyzer tool. This is the tool that I use and everybody in our community uses to determine what is the right price to pay. We take our story and we use it to put numbers in here. The first of which is our revenue growth number. And I'm doing a 10-year analysis. So here's what I've done. Now, guys, you might agree with me. You might not agree with me. That's the great part about having this stock analyzer in our community. This is used over 1 million times per year by our community members for a specific reason. They can put their own numbers in. I did 4, 6, and 8% revenue growth for the next 10 years. Listen, let's be a little more conservative. Let's decrease it. Let's go 3, 5, and 7%. Profit margin, I did 10, 11, 12, and the same thing for free cash flow. Okay? Now keep in mind, guys, in the last 10 years, with lower profit margin lately, they were hitting those numbers. So maybe I'm being too conservative. Maybe the 12 should be in the middle. Maybe it should be 11, 12, 13. I don't know. Now, what PE and price to free cash flow should I have in 10 years? Like I said, guys, high returns on capital, they're getting higher. This just means the moat is getting better and better. And it's a premium company that is hard to replace. If I gave you $100 billion, their market cap today, and said, go compete with Starbucks, it'd be very difficult. You have to go get a bunch of locations that compete with Starbucks where they're already not at. Or go open it next door and compete with them. That would be difficult. So this is a premium company. I put 20, 22.5, and 25. I can understand even higher, guys. I can understand 22, 25, and 28. Remember, Warren Buffett started buying Coke at 30 times earnings, and he still, with dividends, has made 12% per year for the last 35 years. And finally, guys, I'm doing my 9% desired return. This is just the market return to give me my intrinsic value. This is not the price I'm going to pay. Because at the end of the day, if I want 9 or 10%, I'll just go buy an ETF like SPY or SCHD. Why do all the work of buying an individual company? So for me, to get a lower margin of safety, I got to put a higher dollar amount, higher return in there. But I'm trying to find what I think this company is worth. I hit the analyze button. Low price of about 60, high price of 112, middle price of 81. So right now, I'm probably not adding to my position. And I started buying it somewhere in the 70s and lower. I was excited today because our CEO today told me, hey, Paul, Starbucks is a lot lower now. I was like, oh, great. Is it 65? 88. That's not low. That's the funny part. That's what I want you to understand, that I got excited thinking that Starbucks was at $65 a share. Stock number 2, Adobe. Guys, Adobe is an incredible business. They have a great subscription business. They have high customer loyalty, amazing company, down to $349 per share. Guys, this is a company that's 52-week high was $587 just 1 year ago. 52-week low just last month of $330. Our community members have this company. We have 74 community members who voted on this, and they have this as a buy right now. That's incredible. Now, free cash flow. Look at this. This is what I love. 5-year average free cash flow, 7.3. Last year's free cash flow, 9.44. They're growing their free cash flow. And the best part is everyone's focused on net income. Look how much higher free cash flow is in net income. 50% higher. That's so rare to find. So while everybody else out there is worried about earnings, we're worried about free cash flow, and it's significantly higher. Look at this. The current price of free cash flow is 16. For a company like Adobe, return on capital, 31% last year. Have I said anything to you right now that makes you think this company should be down 40% over the last year? Nothing, but it is. Look at this, guys. The last 1 year, 39%. Year to date, down 21%. Guys, if you think to yourself that because the stock is down, it's not a good company, then you wouldn't have bought Palantir at $5.83 after it fell from 45. You'd have missed out from it going from 583 to 190. You wouldn't have bought Carvana. There's so many, you cannot focus on where the stock price goes in the short run. Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. We have no idea what the stock's going to do in the short run. But if I told you that 10 years from now, this free cash flow went from 9.5 billion to 18 billion, is that a much more valuable business? The answer is yes, and that's what should matter to you. So let's take a look at that 8-pillar story here. Guys, look at this. Again, remember we talked about earnings are so much lower? That's why there's an X here. Other than that, it's all checks across the board. And they're starting to buy back some shares at even faster pace, which I freaking love because they don't pay a dividend and they're starting to buy back some shares. That's a great way to return value to the investor. Now, let's go to its analyst estimates. Look at this, guys. $21 a share this year, growing to $30 in the next 4 years. That's 13%, 12.5, flat, 8.5%. That's some serious growth for such a big company that everybody's saying AI is going to ruin this company. Well, they haven't so far. Now, doesn't mean it can't happen in the future. Because remember, when BlackBerry was out there and dominating and iPhone was created, it took a while, but eventually they were destroyed. But I don't think the same case is here for Adobe. Name me the second player in Adobe's market. I'll wait. And there's a few people watching because we get 50 to 100,000 views per video that somebody will say, well, here's a second player. But the point is the masses don't know them. It doesn't mean that they won't know them, but I look at Adobe saying this has staying power. And the best part is, look at Adobe's gross margin, 90%. That means every extra unit they sell, 90% of it goes to the bottom line before taxes and overhead. That's a huge number, guys. NVIDIA's at 70%. Microsoft's in the 60% range. Those are the analysts. That was on earnings per share. Let's look at revenue. 10%, 9.5, 9.5, 7.5, 8% revenue growth. All huge. And imagine that at 80, 90% margins. They're able to really drive a lot of profit to that bottom line. That's what happens when you have really high margin with decent revenue growth. And this is pretty decent for a multi-$100 billion business. That's what's incredible. So again, let's go right to that stock analyzer tool. What is the right price to pay for Adobe? I'm doing 4, 8, and 12% revenue growth for the next 10 years. Let's be a little more conservative. Let's go 4, 7, and 10. Profit margin. Guys, I'm not even focused on profit margin. Let's go to free cash flow, 38, 40, and 42. And keep in mind, last year they did 41.75%. And it's been increasing over the last 10 years. That's what's great. PE, price to free cash flow, 18, 21, and 24. I think that's too low, but I'm just putting that in here because they have increasing returns on capital and they dominate their market with really high margin. But before I show you our price, I want you to remember 25 years ago, I was chasing hot stocks. I was chasing all the tips that my friends' parents were telling me. I got caught up in the hype, hoping that something would stick because I didn't look at anything. I didn't look at buying stocks as buying a piece of the business. Guess what? That's not investing. That's gambling. That's speculation. And over time, I started to realize, without the help of a community, without the help of YouTube, I started to realize that investing wasn't about that. And that's exactly why I created Everything Money. I wanted to give people the tools, the strategy, and the community and ideas that I never had. This can really accelerate somebody's ability to understand investing. So at EM, if you join, you're not just getting our powerful investing software and our very famous stock analyzer tool, you're getting a foundation. We integrate you into the community by watching courses so that we all have the same foundation and get you engaged in our community of like-minded investors who everyone's goal is to level up their investing and get better at investing. Because everyone has the brains to invest, but not everybody has the stomach and the mindset to do so. And you need that alongside all the software and tools. And guys, even more exciting is we're about ready to add a brokerage to our platform. This is going to allow people to go in, link their brokerage to the software, and buy companies as they analyze them, making it much easier. This is the next chapter for Everything Money, and we only want serious investors to be part of it. And I'm going to repeat that. Let me be very clear. This is not for people chasing the next shiny object. If you want somebody to give you fish, we're not for you. If you want to learn how to be a great fisherman, we're there for you. If you're not ready to follow a process, stick with it and put in the work, don't sign up. But guys, guess what? This channel and this community can save years off of your learning. So if you're committed to investing right away and getting better returns and sleeping better at night, start your 7-day free trial today. Click the link below. We limit the spots each day, and we don't know how long we're going to keep the trial open. So if you're serious, this is the moment to sign up. If you're not serious, if you're just trying to fly by night and chase stocks, there are plenty of other channels out there who will help you lose money. So I hit the analyze button here, and guys, check this out. I have a low price of $370, a high price of $790, middle price of $540, and guys, guess what? That's a 15% return in the middle. If my middle assumptions occur based on free cash flow, not net income. That's the really important part. Now, guys, I want to repeat. It's not about chasing what's cool. It's about value versus price. Because what's cool is when the stock was low and you bought it then when everybody else didn't like it. And my next stock, I believe, is my biggest current opportunity if my thesis plays out properly. That stock, Southwest Airlines. Guys, it's an airline and that's probably its biggest problem. But my play here is one thing and one thing only, profit margin. Here it is. In the last 1 year, their profit margin was 1.4%. In the last 5 years, it was 0.4%. Before COVID, they had never had a losing year. And they've had one losing year during COVID. And before COVID, they basically averaged 10 to 15% a year in profit margin, 8 to 10 times higher than it is last year. My play here is purely this will get back to normal profit levels. That's what my play is here. It's in a very tough industry. Elliott Management has taken some board seats and they're instituting a lot of changes. And a lot of people think that's going to change the advantage for Southwest. I disagree. I think it's going to increase the advantage. I don't fly Southwest because I hate the idea of having to find a seat, reserve. I hated that. In fact, a good friend of mine, his wife is a flight attendant at Southwest, and she loves the fact that they're going to assigned seating because Southwest focuses on what they do best, which is having the same planes, having efficient routes, and hedging their fuel properly. Now, let's go look at Southwest here. We have 32 community members who voted. The average is a hold. I want you to see that. Everybody in the community is not just let me emulate Paul. That's what I love about this. People disagree with me on Southwest. Now, let's go to our analyst estimates here. Analysts expect Southwest to make 94 cents this year, 666 in the next 4 or 5 years. At a 20 times multiple, that makes the stock 130 if this plays out properly. It's currently at $32 a share. That's what's amazing about this, the potential there. And guess what, guys? Revenue growth, still going, 2, 7, 5.5, 6, 7% revenue growth. This is solid for a company that's going through its issues right now. It has its computer issues, it had its customer issues, and they're working through them right now. And I believe this has a lot of potential. But more importantly, I want you to see the potential in our stock analyzer tool, because that's where the numbers really come through to show what Southwest could do. Guys, revenue growth, 2, 4, and 6%. Profit margin. Guys, I did 8, 11, and 14. Same with free cash flow. Keep in mind, they had several years before COVID where they did over 14%. I'm putting this at the high side now. PE, still an airline, 14, 17, and 20 times earnings. But guys, I want to show you something. I talked about how important return on capital is. Over the last 10 years, they've done 7.22%, and that's with the last 5 years being negative, involved in that 10%, involved in those 10 years. They were over double digits before COVID. They will get back to that, in my opinion. And I did my 9% return. You guys ready for this? Analyze button. I have a low price of 55, a high price of 163, a middle price of 100. Look at these returns. Potential. This is why I say this stock has the most potential in my portfolio. But it's not going to be easy. It's still an airline, and there's still that chance. Now, along the way, I'm going to continue buying SCHD every single month because I believe in ETFs, and I still want a dollar cost average like I preached to you. And I'm going to continue doing that. And once QQQ, the NASDAQ 100, is a lot more cost effective and reasonable, I will start dollar cost averaging in there. Now, guys, earlier this year, I picked my own personal Magnificent Seven, 7 stocks that I wanted to go head to head with the real Magnificent Seven. So click the video on your screen to see which stocks I picked and how they stack up. The results will surprise you. Thank you for your time.